And I think it means that that leasing game is now stopping. I don't think any central bank will lease gold from this moment. Now, there are leases still running, and the problem with leases is that, you lose possession. Well, I don't think there's anything further insofar as circumstances, whatever they may have been, drove huge great premiums on COMEX, which had the effect of sucking out liquidity because of the arbitrage opportunity, physical liquidity out of other centres, particularly London, secondly Switzerland, and then some other centres as well. That, I think, obviously the premiums have diminished. There still sort of tend to be small premiums, if you like, on the futures market on COMEX in New York. But, the big rush, I think, has basically happened. My reading of it is that you've got to think in terms of the stands for delivery, which have yet to be delivered, which are still sitting in the COMEX warehouses. You can see the charts, if you like, of those totals over time, and quite clearly you've got two peaks. The first one was just after the COVID problem, when we had equally a crisis, and it was a crisis which led to gold being moved from London to COMEX. You may remember that. We have a second crisis now. It's less obvious because we don't have a COVID, if you like, driving it, but I have no doubt at all that it's a shortage which will persist. On top of that, we don't know who's been standing for delivery, but the rate of stand for delivery has increased roughly fourfold in the first quarter of this year over last year. This is, this, as I understand it, is much of it is yet to be delivered. We're talking about 400 tons in the first quarter. So that has to be covered, if you like, because otherwise, if you don't cover it as a bank, you're at risk. And so I think that does explain that. But there is another factor, and that is that because quite a lot of this gold was coming out of the Bank of England, and because, therefore, a lot of this gold, or some of this gold, was leased gold, which ordinarily would remain vaulted in the Bank of England and merely be a book entry transfer. Because that has come out, it has alerted every central bank with balances in both New York and also London, and I suppose also Switzerland, to the risk from leasing. And I think it means that that leasing game is now stopping. I don't think any central bank will lease gold from this moment. Now, there are leases still running, and the problem with leases is that, you lose possession. It may remain vaulted, but you've lost possession. And furthermore, that gold may be rehypothecated into another lessor. So this is a situation which is actually very, very bad for any central bank wanting to protect itself against the ending, if you like, of the fiat currency system. As far as the market is concerned, the withdrawal of this leasing is going to withdraw a very important part of the supply, which is necessary for the derivative system to work. It needs the liquidity, if you like, of leasing in order to work. That is now going. So what we have, I think, is even though the premiums have basically gone out of COMEX futures now, we have, I think, the potential for a systemic problem arising from the lack of supply in a market where the future value of paper currencies is diminishing. This is, it really is beginning to mount up. It's a number of things all coming together. There was a film a long time ago called The Perfect Storm, and I think it's an apt description for what is basically developing in the gold market. Yes, I think it's a fair point, and you're showing the Bank of America share price is actually to the point. And the reason it's green today, I guess, is because people have been shorting it fully aware of the problems that banks are likely to have. And today, a little bit of a bear squeeze. They've been closing the position. There may be a little bit of price management in there. I mean, who's to know? Who's to say? But the entire banking system, I mean, if you look at the wider banking, financial ETFs and so on, they have been extremely weak. And this does, I think, indicate heightened fears, if you like, of systemic risk. I mean, the American banking system is highly leveraged compared with the past. I guess that you're looking at around about 15 times asset to equity. So bad debts doesn't take a lot in the way of bad debts to wipe out the equity and give you negative equity, if you like. Worse than that, of course, we've also got the Fed is already deeply into negative equity. So, how does the Fed actually rescue a commercial banking system or backstop a commercial banking system when it itself is deeply in negative equity? Well, I mean, the answer to that one is that either it prints the money, which of course is if you like, credit replacement, and in a sense would just devalue the dollar even faster. Or alternatively, it turns around to its government or its shareholders, and in this case, I think we assume it's the government, though we hear all sorts of things about how it's privately owned, and so. But it would turn around to the government and say, "Look, we've got to recapitalize," and so you've got the prospect of a government in a debt trap recapitalizing its central bank. Is this going to sort of spread enormous confidence around the world about the outlook for the dollar? Well, questionable, I would say. Moving on to other areas where there is very high bank leverage, higher than the United States in particular, you've got Japan, obviously, and you've got also the Eurozone. I mean, Eurozone banks and Japanese banks typically have asset to equity ratios in excess of 20 times. And that is something that's really come about by banks expanding their credit in order to be profitable in times of negative interest rates. So the damage of negative interest rates, if you like, is still very, very much with us. As to where the risks actually lie, I think we've already seen American banks try to move out of risk lending, away from lending to corporates in particular, into lending to the government. And the lending to the government is very, very much short-term lending, like T-bills and so on and so forth. So I think in a sense, the financial sector or the banks have de-risked themselves. Now, obviously, we're talking about the top level banks here. What goes on underneath that? I think there are a lot of banks still trapped with bad commercial real estate loans. I note that according to FINRA, there is something around about 900 billion, in other words, close to $1 trillion of margin debt in the equity market. That is going to be, I think, a problem for some. And on top of that, if I'm right about the combined effects of a deflating credit bubble and tariffs, then a lot of the collateral that backs loans for banks is going to be underwater. So, we do have the potential for, if you like, a crisis which makes the great financial crisis look really like a tea party. I'm afraid. So that I think in a nutshell, those are the problems. We've got a commercial banking system which is going to have to take on or weather a lot of bad debt, which is undoubtedly going to put some banks into negative equity. They will have to be rescued or something happen to them. And at the same time, you've got central banks themselves in negative equity trying to rescue a fiat currency system. And on top of that, as far as the Fed is concerned, they've got the problem that because the US and other economies are going into a slump, I'm calling it a slump, not just a recession, then government finances are going to go horribly wrong. And that basically can only lead to one thing, and that is higher government borrowing, which means higher borrowing rates. The risks to to people holding dollars, I think, are just going to escalate. And under those circumstances, if they're going to hold their dollars, they're going to need higher interest rates. But higher interest rates makes the debt trap against the government worse. So what do we do? I mean, the Fed, I think, is in an impossible position on this. Yes, I mean, it's quite clear that one of the consequences of these tariffs is to drive foreign nations, if you like, to cooperate more with each other, given that it becomes difficult to export to America. And we've seen this already. I mean, China has, for some time, been talking vaguely with South Korea and Japan about a mutual trade agreement. That has now gone to the top of the agenda. Now, I think this is very important because you're going to have three technological powerhouses coming together. And the implications, if you like, for the Industrial Revolution, for the entire Shanghai Cooperation Organization and BRICS, and any other nation which feels that it is being badly done by America. I mean, we're going to see the majority of the world, and by that I mean the world which is not beholden to financial markets in the sense that that we are. I mean, if we have falling financial markets, it's a disaster. If, let us say, an East African country has falling financial markets abroad, I mean, it shrugs its shoulders and says, well, you know, there may be some negative consequences for us, but this is not actually all that important in our scheme of things. So I think that Trump is leaving a geopolitical vacuum, which I think will be very rapidly filled by the partnership between Russia and China. And not only will they be bringing in, I mean, we know that Russia is already bringing in, admittedly jointly with China, Iran. You've also got North Korea, who are said to have been helping Russia on the Ukrainian front. And now we're going to get, I think, virtually every nation in Southeast Asia is going to swing towards this partnership.